The IMF, the World Bank, intimately tied with U.S. empire. The U.S. military even admitted in documents that were published by WikiLeaks that they're financial weapons of the U.S. military, the IMF and the World Bank. That they're taking U.S. empire out of it and they're having it basically be a direct weapon of the bank.
So I think the focus now should be on the silver component of this.
That's it. That's the only thing. It's the broad market really has been, gold's broken out. It says the game has just begun.
In this video, two voices you must hear come together: investigative journalist Whitney Webb and top market analyst Michael Oliver. Whitney exposes how the IMF and World Bank, once tools of U.S. power, are now being re-engineered by global bankers to control the next phase of our economy through programmable money, digital IDs, and climate wallets. She's sounding the alarm that the financial system itself is being weaponized, not against nations, but against people. And then, Michael Oliver connects the dots from that shift straight into the markets, revealing how silver is setting up for the same kind of breakout we saw before its historic runs in 1980 and 2011. Together, their message is clear. A massive monetary reset is already unfolding, and understanding it now could make all the difference in what happens to your wealth next. So don't go anywhere, and let's start the video now.
The IMF, the World Bank, intimately tied with U.S. empire. The U.S. military even admitted in documents that were published by WikiLeaks that they're financial weapons of the U.S. military, the IMF and the World Bank. Yeah.
So
now what they're doing instead, by reimagining them, is that they're taking U.S. empire out of it and they're having it basically be a direct weapon of the bankers. So instead of the bankers like buying up U.S. politicians and influencing U.S. empire and getting what they want that way, they're reimagining it to basically create this new economic system that we've seen bits of over the past few years, the idea of programmable, surveillable money, and also this idea of a voluntary carbon market, the goal of which is to have it be voluntary in name only, not unlike digital ID and all of that stuff. If you want to know more about this, you can look at the Glasgow Financial Alliance for Net Zero that was created by Mark Carney and Mike Bloomberg, which somehow the UN decided were the best people for the job of saving the planet. They're in charge of climate finance for the United Nations. The stop and frisk New York mayor billionaire from Solomon Brothers, Mike Bloomberg, and the former head of the Bank of England and Bank of Canada and former Goldman Sachs guy, Mark Carney. That's who's saving the planet for the UN. They're the ones reimagining this, the whole multilateral development banking system. And part of this involves this carbon market play where the World Bank, along with Google and some other actors, are developing climate wallets.
I now think you could go to 100 to 200 in the next couple quarters. We've done a lot of technical rationale for that. It's not just a gut feeling, okay? But we've shown that if you look at silver on a chart, just an arithmetic chart, go back to 1975 when gold was legalized. Gold has had huge surge up, then a pullback and a range for a decade. Then another huge surge up and a new higher range for a decade plus. And now is into another surge, which is, by the way, only half as strong so far, measured logarithmic scale, ratio scale, to the prior two bull markets. If gold matched them, it'd be $8,500. Okay, but how come silver is stuck in this box for 50 years? We showed charts of copper and lead. Okay, real exciting stuff, lead, But in the 70s, 80s, 90s, and into 2000, they were stuck in a range, sort of like silver is now still stuck in. And in 2005 and 6, copper quadrupled in about a couple quarters. It just left that old reality behind. And then over the subsequent decades, a new range that if you divide the middle of that range it's been living in for the last 15 years or so, it's 4 times what it was between 1970 and 2005. Okay. How come silver's still stuck in that range? Then we look at lead, and lead had the same situation for multiple decades, caught it at a price range, blew out of it in 2007, not in sync with copper on its own stuff, quadrupled in price in a matter of a couple quarters, and then lived in a new reality, way above that old reality. How come silver's here? Well, there's some arguments that are likely valid that it's been artificially depressed, suppressed, etc. But whatever the reason, you can't fake reality forever. And if gold, the other monetary metal, has gone from, a peak in 1975 at 200, then in 1980 was 850, and now we're 4,000, and yet silver in 1980 was 50, and we're at 48. Okay, now something's wrong there. Forget any intricacies of special situations. What's going on? I mean, lead's 4 times its price then. Copper is. Is silver, anyway, there's a point to be made there. Sometimes markets make mistakes. We know that. As an investor, if you're around long enough, you've seen bubble markets make a peak. And when it falls apart, you look back and say, oh, golly, now I can see why. It was irrational, too high for too long. Even if the concept underlying it was valid, it just went too far too long. And the same thing goes on the downside. Markets make mistakes on the downside. They get down too low. They lay there. Nobody likes them. They're not doing anything good. So who's going to invest in them? And then when they wake up in a thunderbolt. The technicals of silver right now argue to us. Now we've got one trigger level that we'll talk about in a minute. That when it's triggered, we think over the following 2 quarters or so, in other words, 6 months or so, silver could go to at least 100, more likely to 150 to 200. In other words, you could quadruple its price in a matter of a couple quarters, doing the same thing that's been done in many other markets over the past 50 years, here, there, so forth. And the technicals justify assuming that. It's not just gut feel, okay? And anyway, that's what we see. So the 60-70, forget it. No, we don't believe that. My own personal investments, which I have to disclaim at the end of all our reports, is what do I own? Okay. I'm wholly emphasizing silver and silver related. And I think some of the miners might be as much bang for the buck, if not a lot more, than what silver might do. And the reason is they're still very lagged to the gold miners historically. They're very lagged to almost any way you want to measure to gold. Or the silver miners are the real dogs. The gold miners have gone up, and notice GDX, for example, had a high in 2011 in the 60s. Well, it went up to $80. Okay, pull back, and right now we're like 68 or 70. I mean, we're 70 area. Okay, so it had a pullback, but it burst through this at like a doubling in price in a matter of a handful of months, just to get above 2011 high, which, as we know, gold's way above that. It was $1,920. Okay, so the gold miners said, I'm here too. I'm back. Okay. The silver miners aren't above that high. For SIL, for example, that high in 2011 was at 90. We didn't get there. I think we're going to get there and then some. I think it's, again, sort of the phenomenon. I'm talking about what I think silver is going to do technically. The silver miners perhaps should best be viewed not as miner by miner by miner analysis, but more as, hey, they got the stuff underground and it's not priced at even the per ounce level. Okay, you're in effect buying silver bullion at 10 cents on the dollar, okay, by buying the mines. And I think that acknowledgement will come when silver runs its tantrum move. It goes to the new reality. And I think at that point, you want to be long silver. Perhaps if you want to, silver calls that go out a year, let's say, and the silver miners, as opposed to gold and the gold miners, which will also be going up, but less so. So I think it's the focus now should be on the silver component of the monetary metals. I've got into a handful of individuals, but basically I think the thing, rather than being specific and relying on some analyst's analysis of this miner or that miner, this one's a dog, that one's good, I think you could throw darts. I think the whole pack of them is going to go up because the power that will drive them isn't going to be what's the profitability of this company versus that. Right. It's basically, my God, an underpriced category, and money will just flow into it. And even garbage stocks will go up. Okay, you get my point. Yeah. That's the kind of phenomenon I'm talking about. I think the pullback you just saw is a buying opportunity. Again, when you put it in perspective of what has gold done since the government legalized it. Well, it had a bear market low in 1976 after hitting 200, and when it was legalized, it dropped to $103, mid-76. Between mid-76 and 1980, 3.5 years, it went up eightfold. And the conditions that drove that, we argue, are far less dynamic than the ones we're sitting on right now. Okay, 2. The next bull market started in 2001 from a $260 low and went to 1920. Eightfold move. Spanned 10 years, but an eightfold move. Okay, we're only fourfold off the bear low, $1,050 in 2015. So people say, oh, it's overdone, it's overdone. There's another argument that it's just beginning. And it's the first charts I sent you. The first chart shows a spread relationship between an ounce of gold and the price of the S&P 500. And it goes back to 2013. Remember, gold peaked at 11. In 2011, 12, 13 especially, it's entered a bear market, which didn't bottom until 2015, okay, end of that year. During that time, it was underperforming the S&P 500. The spread was collapsing along with the net price of gold. But then, in the 11 years since that, during an 11-year period of that basing process, there have been 4 rally highs in the spread, meaning gold has had a rally versus the S&P, relative performance-wise. And each of those rallies, by the way, was actually strong upside in gold, net price. But there's a clear base that a kid with a crayon could draw a line across. 4 separate peaks that are almost flat. You're pushing at that line now, again. Right now, the spread between gold and the S&P is 58.6%. Ounce of gold, D's gold, using D's front month future, S&P. If you ever close a month at 60%, and we were intra-month above that last month, you ever close a month out at 60% on that spread breaks out of an 11-year relative performance base. It says, I'm just beginning. Again, when the spread moves up, net price of gold's moving up. So that chart says, as an asset class choice, stock market or gold, it'll break out versus the S&P in saying it's just beginning. And then it's not broken out yet versus the S&P. But we also ran the spread of gold versus the New York Composite Index, which doesn't have a front end weighting of 5 stocks that constitute 30% of the overall index, like S&P, or 5 stocks in the NASDAQ 100 that constitute 50% of that index. Okay, I measured it against the New York Composite and the Dow 30. Same time span, 2013 to present. They've broken out. Already gold is broken out versus those two unfront-end loaded indexes of the U.S. stock market. The only thing that's kept it from breaking out against the S&P is, again, a handful of those front-end stocks. That's it. That's the only thing. The broad market really gold's broken out. It says the game has just begun.
Every word from Whitney and Michael today opens your eyes to the system we live in and what's coming next. If you found value in this conversation, make sure to hit that like button, subscribe, and turn on the bell icon. Because the next video could be the one that changes how you see the entire financial world. Stay informed and stay prepared.